hearing a lot of theories that the end goal of the newly announced tariffs was to tank equities, slow growth projections, and force the Fed to cut rates in order for the US to be able to issue debt at lower rates. I have no idea whether or not this is true, but let's break it down and see if it makes sense. First, we need to understand the relationship between the Fed funds rate and the rates the US pays on its debt. A lot of people think, oh, the Fed declares this magic rate, and that's where the government borrows. The Fed funds rate is an overnight target rate range that the Fed can effectively set a cap and floor on using the limited tools at its disposal. What it is not is a prescriptive rate where the US Treasury funds itself. Those interest rates are a function of a combination of lots of different market factors. Sure, if everyone is too terrified to buy risk assets like equities, and the Fed says, who cares about inflation? We're cutting rates. There should theoretically be more demand for safer assets like US Treasuries. And when you really want bonds, you're willing to accept a lower interest rate and a lower return, meaning that the US probably gets to issue debt at lower interest rates. How much money are we planning on saving with this plan anyway? Let's say the Fed cuts 25 basis points at its May meeting. We'll generously say that interest rates from 0 all the way to 30 years all go down by 25 basis points. That would be an annual interest savings of $22.8 billion on $9.1 trillion worth of debt. If we drop rates 100 basis points across the curve, that's an annual interest savings of $91 billion. Sounds great, but it's a drop in the bucket compared to a budget deficit of $1.8 trillion. Again, this is not only assuming everything goes perfectly, but we're ignoring the potential drop in tax revenues from erasing over $7 trillion in value in the stock market in just the last week alone. And there's a few potential complications that I haven't heard anyone talking about. Because the weighted average maturity of the US debt is 6 years, rates just can't be low for short-term rates, which the Fed controls. They have to be low for longer-term rates as well. And they have to stay low for a long time in order to get through all the Treasury auctions over the next year. Unless, of course, the US wants to totally shift the balance of its issuance into shorter-dated Treasuries or issue a massive amount all in one fell swoop. 10-year rates are still at 4%. They haven't really moved, while the S&P has lost more than 10% of its value in the last week alone. The second thing is, over the past several decades, while the US has been running up this huge trade deficit, we've been flooding our trade partners with US dollars. What do you do when you have a bunch of US dollars? You go buy US dollar denominated assets, like US Treasuries. What happens if our biggest trading partners stop receiving US dollars because of the impact of these tariffs? They probably stop buying US Treasuries. How are we going to lever and grow our way out of a recession or a depression if no one is buying our bonds? To me, this is why crypto has actually kind of outperformed in an otherwise risk-off move. It's not just about expectations for monetary policy, but more about a perceived newfound risk that the US dollar might no longer remain the reserve currency of the world for the first time in my lifetime and likely yours.